Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a consolidation where we have a parent-subsidiary relationship, the parent owning over 51%, having a controlling interest in the subsidiary, but not 100%. Therefore, we will be dealing with a non-controlling interest in our practice problem. Major point of focus is going to be where there's a bond sale from S or subsidiary to P or the parent, and it is at a discount. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. We're going to go through the information first, then we're going to grab pieces of that information to use as we go through the practice problem. So we have P purchased a percentage of S voting common stock on January 1st, 2000 X 0. P is going to be the parent, S the subsidiary, and the purchase took place, the original purchase, 2000 X 0. That won't be the date of consolidation, but the point in time that the purchase took place that results in the need for consolidations going forward. The percentage of stock, the controlling interest, 70%. The cost, the amount that was paid for that 70% interest by P in interest of S, $120,400. The non-controlling interest, fair value of the net assets, in other words, as of the point of purchase, $51,600. The net assets at purchase, meaning assets minus liability, equal to or the equity section at the point in purchase of, is $116,000. Book value and fair value of assets and liabilities are the same, except for, meaning at the point in purchase, we had the book value and the fair value of each line item. Assets, liabilities were the same, except for equipment, which had a fair value which was $56,000 greater, which is going to result in a differential we'll have to deal with. Also, because it's a depreciable item, we'll have to deal with the depreciation and accumulated depreciation related to it. Therefore, we need the remaining life, and that will be 14 years for our practice problem. We'll be using the straight line method in order to account for the added depreciation. January 1st, 2000 X1, so a year after the consolidation took place, or the purchase, not the consolidation, the purchase took place. S sold bonds to P. So S is the subsidiary, they sold the bonds to P. So they basically issued the bonds, meaning P paid S for the bonds. So S is the one that issued the bonds to P for cash received from P, and therefore S will be paying out the interest and P will receive the interest and whatnot. So par value, 50,000, the percent, 8%, years are going to be 10 years. The cash received was 45,000. Therefore, 45,000 is less than the 50,000. That means that they were issued at a discount. So note that this is going from S to P, so directly the bonds were issued directly. That's a little bit easier than what we'll see a little bit later, which is the case where one of the companies issued the bonds and then the other company purchased it from a third party. So in other words, in this type of transaction, we'll see a nice mirroring between S and P with relation to the bond activity, a mirroring that won't be as reflective if one of them was to have purchased the bonds from a third party, which we'll see at a later point. So interest is going to be paid on January 1st and July 1st. On July 1st, 2000 X1, S sold land to P. So the subsidiary then sold land to P in 2000 X1, July 2000 X1, cost $24,000, sales price $32,000. We're going to be using the fully adjusted equity method, or P will be using that in order to account for their investment in S. And the consolidation, we want to consolidate as of 2000 X2. So the purchase took place 2000 X0, and now we're in 2000 X2, point of consolidation. Straight line amortization of the bonds is what we will be using. All right, so first we want to focus in on these bond transactions. So what we have on the right is P. So we have the trial balance for P as of the point of the consolidation. We have S's trial balance as of that point. We will be consolidating these two together as normal. We will be having to eliminate the investment in S stock and the income from S, these being recorded on P's books for their investment in S. Our new thing, however, here is that we're concentrating on these bond transactions. So we know that this bond was issued. So if I look down here on the bond information, so we have January 1st, 2000 X1, S sold bonds to P. So S is going to be issuing the bonds, P is being purchasing the bonds. The par value is going to be the 50,000. So we'll see the 50,000 on the books. And then we have the percent of the bonds, 8%. The years are going to be 10. they were issued at 45. That means there's a discount on the books, and then the interest is going to be paid January 1st and July 1st. So let's just consider the accounts over here that we see on the books. So S is the one that issued the bonds to P. So P paid S for the bonds. So on S's books, they issued the bonds. And from an accounting perspective, like when you learn accounting, you actually learn probably from the issuer side more often, because bonds are often used to finance corporations. So you learn from the issuer side. If you just think about bonds without accounting background, you probably know more from a purchasing side if you've ever invested in bonds. But you're probably, if you've been working in accounting, then you've been probably trained in financial accounting on this side, the issuer side more, right? So they issued the bonds at the 50,000. Then they had the discount on the bonds being a debit balance account here, because it's going to be a contra liability account. So we see that. And then on the other side, on P's side, the P being the purchaser then of the bonds, we see the 46,500, that being the investment in the bonds. That investment in the bonds over time needs to increase to the 50,000, just as the discount here needs to be basically removed over time to get to the 50,000, the face amount of the bonds at the end of the period, at which point then the maturity will happen, and they'll net each other out at that time. So you'll have that same mirroring kind of thing. This one needs to be going up. This one needs, this discount needs to basically be going down. We need to be left with 50,000 here. We need to be left with 50,000 there at the point of maturity. So let's take a look at P's entries. Now we're looking at P's entries, which is reflecting this account, P being the purchaser then of the bonds. And they're going to be the ones that are getting the interest on the bonds and the amount at maturity. So let's think about the transactions that will happen here. Now, I'm just going to go through the transactions and that will make up what's already on the books. We're not going to be posting these. We're just basically reconstructing what has been taking place for P in this case with relation to the intercompany bonds. That will help us then to reverse that when we do the elimination or consolidation entries. All right, so let's go on down here. I'm going to pull out the trusty calculator. So here's the trusty calculator. It's in the wrong screen. Here it is. There it is. So now we're going to say that the payment of the interest was January 1st and July 1st. So that means the payment didn't happen until it's not going to happen until the next year, even though there'll be an accrual entry, in other words, on December as of the cutoff date for the interest that's accrued that hasn't been paid. And then in the new year, we're going to have to basically account for the reversal of the accrual, which will be the first transactions we're considering. In other words, there's going to be like an interest receivable that would be on the books that we're going to have to basically reverse out as part of our receiving of the interest. And we can account for that a couple different ways, but I'm just going to reverse the accrual and then debit the cash, and we'll see the cash being paid in 2 points. So let's check that out. We're going to say, all right, 50,000. We're going to say divided by, times 0.088%. That's going to be 4,000. That would be on the year. And then we get paid every twice a year. So we're going to say divided by 2. That's going to be the 2,000. So the 2,000 was basically accrued as of December 31st of the prior year, but wasn't yet paid until January. So in January, we're going to get that payment. So we're going to say, all right, up top in January, we're going to get the cash. We would expect then to have a debit to cash, and the other side not increasing interest income, but increasing or decreasing the receivable then going down. So this is at the end of the day, because we're going to have another accrual at the end here. So then we would expect to see kind of our normal type of transaction where we would have our second interest payment happening in July in the middle of the year. Interest going up amount by that 2,000, same calculation on the 2,000. Then we would expect this investment needs to be increasing to 50,000 in a similar way as the discount needs to be decreasing to the 50,000, and we'll account for it in the same way. We're going to say, all right, well, that's going to be the 50,000 minus the 45,000. Went on the book for 45. We're just going to amortize that using our straight line method. So we're just going to take that and divide it by the 20 years, because it's 10 years times 2, because it's 2 times a year. So the number of periods would be 20. So that's going to be the 250. And then the difference then is going to be the interest income of the 2,250. So that's going to be that. And then at the end of the year, you would expect then in December, basically same transaction, but we haven't yet got the money. We don't have the cash yet because we're going to accrue that. We've earned the revenue, but we won't receive it until January of the next year. So we're going to debit the receivable now, which would match the ending receivable we currently have on the books here. And then we're going to have the investment, same calculation here, and then the interest income here again. So that means that the total amount effect then would be the $4,500 that's going to be included in interest income. So that interest income is going to be included right there. So there's the $4,500. In practice, it might not be the only thing in interest income, right? So we'd have to kind of pull out the interest income that came from the related party bonds. But, we want to be able to see that here. So that's going to be that on this side of things. Now, while we're over here on P, let's also take a look at basically the equity method and see if we can reconstruct this account and this account with the equity method. We're not going to be able to reconstruct this one completely because we're only going to be looking at the current year, but we'll be able to take this one, and it's our standard kind of equity method on P's books. So we've got the investment in stock and the income. So typically the normal thing that we would do, I'm going to pull up the trustee calculator, pull in the trustee calculator. We've got S's net income. That's going to be income minus the expenses, $45,000. We're going to be taking that $45,000 times the percentage, I think it was 0.7, the controlling interest. That would give us the $31,500. So that means we're going to record our interest, or the P's interest in S, or portion of net income, with 70%, $31,500, and then the other side going to the investment account, and the investment account and the income from S. Then we're going to say normal kind of equity method things is we take the dividends that were issued by S, 9,000. So I'm going to take that 9,000 times 0.7, and that's going to be meaning that P would have got 6,300 in dividends, decreasing then the investment in S. So there we have that side of things. Then we also have this item where we had the equipment that's going to result in depreciation. So the data we have down here for that will be the equipment had a greater 56,000 of the fair value over the book value at the point in time of purchase. So that's 56,000. We're going to have to add to the depreciation for it, divided by 14. That's going to be 4,000 per year on the depreciation. We're going to multiply that then times the percent, or the controlling interest, which is 0.7, and that's going to be that 2,800. So that means the income, the amount that's representing income on P's books for S, is going to go down by the 2,800, and the investment then going down by the 2,800. So then if we take a look and add these up, so let's go ahead and pull out this thing all together. And we've got the income from S is going to be the 28,700. That's going to be this income from S, and income from S here. The investment in S stock then is going to be this and this and this. So that means that if we look at this number, the 28,700 representing in the income from S, the investment, of course, not tying out to that 22,400, because this represents more than just 1 year of activity. Now let's think about S's side of things. So if I look at the trial balance, now we're going to go to the S's side of things, and we're going to go back to the items related to the bonds. So we're going to think about the bonds. Obviously, the equity section is reflected by S, by the net income and whatnot. Their whole books is being reflected in these items. With regard to the bonds, we got the intercompany transactions here. So we're thinking about what's going to be recorded on S's side for the current time period. They're the one that issued the bond, so they got the 50,000 on the books and the discount of the 3,500, and they're going to be recording then the interest expense related to the bonds. So let's see, we would have a mirroring transaction. Remember, this is what happened on P's side. So we calculated with the bonds that we had. Let's pull out the bonds here. So we got our information on the bonds, and you'll recall we had this accrual issue that we had to deal with, and we're going to have a similar kind of other side of the accrual. That was the 50,000 times 0.08 divided by 2, and something funny happened there. 50,000 times 0.08 divided by 2. There's our 2,000. Now that 2,000, we're going to have to reverse the accrual that happened last time period. So that's going to be, in our case, now interest payable. It's going to reverse the accrual of the interest receivable, and that's going to be a debit, and then we're going to credit the cash on this side. Then in the current time period, which you would expect this to be happening in, what did we say, July? I don't have the, July is that one of the payments took place. So we're mirroring this payment, and I'm just going to mirror it exactly. I'm going to put the credit on top because I just think it's easier to see that way. See how when we reverse it like we did with this one to put the debit on top, it's kind of harder to match them up. So I would just, cash is affected first. I'm going to just put that on top and say, oh, here's the debit on this side. S would have the credit there. Then the 250 is going to mirror for us nicely here. It will not later when we think about a situation where someone purchased, one of the other companies purchased the other company's bonds from a third party. So when the issue happened, when the issuance of the bonds went directly from one to the other, you'll have this nice mirroring transaction, which is great. So we're going to say, all right, that means that the discount's going to be going down. Same kind of calculation for it because S is recording it as a discount, 50,000 minus the 45,000. So they put the bonds on the books at the 50,000. Then they had the discount of the 5,000 they put on the books, and then they got to amortize that 5,000 over divided by the number of periods, 10 years, 2 times a year, so 20 periods, and that's going to be our 250. So 250, and then the difference is going to be going to the interest expense instead of the interest income. So very nice mirroring type of thing here, and we could see the opposite transactions. Then at the end of the year, remember at December 31st, we're going to need an accrual entry because we're not going to get paid until January of next year, but we've accrued the expense at this point. So same thing we had last time where they accrued the income at that point. So this time we're going to have interest payable because now we have a payable rather than a receivable because they owe the interest. And the same thing as up top, we got the discount on the bonds, and then we have the interest expense to $2,250 on the interest expense. Once again, mirroring what happened over here. So then if we were to add up then the interest expense that's happening, we've got the 2,250, the 2,250, the 4,005, the 4,005. That's going to be these items, the interest expense and interest income will of course need to be eliminated because they're intercompany transactions, and we'll be doing that and seeing that when we go to our elimination entries. So then if we scroll down, we've got our information down below, and we're going to now be doing our transaction or elimination transaction. So standard process for the elimination transaction, because we're kind of focusing in on the bonds. So we'll just practice a nice, clean, easy elimination transaction without any kind of adjusting table that we're going to use or anything like that, just to get back to the core concepts here. We're going to say the investment in S. So here's the investment in S. That needs to be removed. Don't think about the number. We'll get back to the number in a second, but I'm just going to put that first, and then we're going to have the reduction of the equity section for S. So we've got the common stocks on the books here at a credit. We will debit it to remove it. Same kind of activity. Here's P's debit. Here's P's amount. Here's S's amount. Here's the total, 124,000. Then we're posting this amount, the 37,000 here. And that'll take out the 37,000 S amount in essence back to the 87,000 P's amount. We're going to do the same thing for the retained earnings. Retained earnings, 87,000 for S. It's a credit here. We're going to debit it in our journal entry when we post it. Here's P's, here's S, here's the total. We're removing S's back to basically P's, as we can see here. Then we're going to do the same thing for dividends, except for the dividends has a debit balance. Therefore, to remove it, we will credit it. So we got the dividends on the P, the S, the total. Then we remove S to bring us back on over to P. Then we have the income from S. So income from S is going to be down below here. What we will do is we'll pull out the trusty calculator. We're going to take the 45,000 times the 0.7, which is the controlling interest portion. That's going to be the 31,500. So there's the 31,500 that will go there. When we post that out, by the way, it doesn't bring it on down to 0 yet. We expect it to be 0 at the end of the practice problem. It will be. I'm pretty confident that that'll work. No, we'll get there. So then we got the non-controlling interest in NA and the net income. That's going to be this 45,000 times the 0.3, the non-controlling interest, the 13.5. So there's the 13.5 and the 31.5 adds up to the 45. Then we're going to go then to the non-controlling interest in NA. So now this middle portion, all of this stuff, represents basically net assets or the equity section at this point, which we will then break out between the controlling, non-controlling interest 70 and 30% respectively. So we can add this up in a couple different ways. We can say, hey, well, why don't we add up the assets minus the liabilities? 24,900 plus 1,600 plus 4,000 plus 28,000 plus 26,000 minus 60,000 minus 86,000 minus 2,000 minus 50,000 plus 3,500, and that'll give us 160,000. We should be able to get the same thing if we add up the equity section of that 160,000. Let's do that. That'll be fun. 37,000 plus the 87,000 minus the 9,000. Then I'm going to kind of cheat and just add the net income down here, the 45,000. There's the 160 once again. That middle portion that we put in here should also add up to that 160 because that's what we're allocating out here. Let's try that. 37,000 plus the 87,000 plus the 31,500 plus the 13,500 minus the 9. That gives us that 160. Now we're just going to take that and multiply it times the 70-30 relationship, so times 0.7. Let's start with there. There's our 112. That's going to go to the investment side of things. And if we take that 160,000 times 0.3, we get the 48,000 down below. So then if we post this out, then of course we talked about all the equity items here. We've got the 13.5 going on down here. There's the 13.5 non-controlling interest. Non-controlling interest in the net assets is going to go up top. There we see that here. The investment in S stock, the 112,000 going into the investment account, that not yet at zero at this point. It will be zero at the end of the problem. Next transaction is going to be dealing with the depreciation on the equipment that we had to put on the book. So in other words, here's the data. Book value and fair value of assets are the same except for the equipment, which had a fair value that was greater by 56,000. So that's going to be the differential we had at the point in time that the purchase took place. So we're going to have to do a few things with it. One, put that 56,000 on the books. We'll do that later, and we'll think about this. And this time there's a couple ways you can think about it, but we'll think about it this time as breaking out basically kind of like the income statement side of things and then the balance sheet side of things. So we'll think about the balance sheet side of things later. Right now on the income statement side of things, where we have the calculation of the expense related to that 56,000, we're going to have to record because that's going to be something S isn't recording. So we got to like do it when we do the consolidation. So we're going to take the 56,000 divided by 4,000. So there's going to be the 4,000. That's going to be just adding to the depreciation expense we will have. Now, the other side, you could think about it as going to accumulated depreciation and then think about the rest of it in another way. But we're going to deal with the balance sheet side, like accumulated depreciation, in another entry later. So right now, I'm going to think about it going to the other side needs to be adjusted to the income from S and the non-controlling interest in the net income. So we need to break that out. So we'll break that out in our good old 70-40 or 70-30 breakout, 4,000 times 0.7, then go into the controlling interest or income from S, 2,800, and the 4,000 times the 0.3, then 1,200 go into the non-controlling interest. So then we're going to say, all right, there's the depreciation down here, depreciation being recorded, and then we got the income from S. That's going to be included in this number. So it's included here. That took us down to zero, which is exciting because that's where we needed to be. And then the non-controlling interest in net income is going to be down here. There's the 12,300. Notice it's a credit. It's basically bringing down this amount because this amount kind of is reflecting the net income that is being allocated to this non-controlling interest, which went down because of depreciation that we're kind of allocating to it. So that's the 12,300 going there. Now let's go on down to the balance sheet side of things. So we've got the prior transactions up top. So those are being included in the consolidation entries, as is the current transaction that we are working on. And that's going to be the balance sheet side of this, basically machinery and equipment type of thing. So we had the same 56,000. Now we're looking at the balance sheet, meaning or including that we'll have to put the actual machinery on the equipment. The depreciable asset's going to be debited. So we'll increase the depreciable assets. So there is that. Then we got the accumulated depreciation, and we're going to include all accumulated depreciation up until this point in time, including the current time period, which is why we didn't credit it up top, because we're going to include it down here as we think of just like the balance sheet side of stuff. So calculation, then we already calculated the 4,000. So we've got the 4,000 there, and then we've got the number of periods that have passed until this point, which I believe is going to be 3 years. So I'm going to say times 3. and that's going to be the 12,000. So that, why is it 3 years? It's because the consolidation took place 3 years ago when the actual purchase took place for the consolidation. Therefore, it's been 3 years that this added amount's going to have to be included, and we have to include the whole thing each time we do the consolidation. So there's going to be the 12,000. And then we're going to take that 12,000 and we're going to be breaking that out between the balance sheet side of things for the controlling and non-controlling interest, that being to the investment in the stock, and the non-controlling interest in the balance sheet side of the controlling and non-controlling interests. So let's do a little calculation on that. We got the 56,000 minus the 12,000. That's going to be the 44,000, breaking that out between the 30%. If we take the 70% of that, we got the 30,800. If we took that same thing, 56,000 minus the 12,000 times 0.3, then we got the 13,200. Posting this out then will look something like this. We got the machinery going up top, so that's going to be included up here. The accumulated depreciation is going to be included here, so we have the increase in the accumulated depreciation, then breaking that out between the investment and non-controlling interest. Investment in stock going to be included here. We're not yet at 0, but we're getting there for this account. Then the non-controlling interest in NA included in this amount there. Next, we're going to deal with this intercompany transfer of the land. So there's a land sale from one company to the other company. That happened on July 1st, 2000 X1. That's a prior year. That didn't happen in the current year. Therefore, we're not going to be dealing with like the gain that's affecting the net income. We got to think about basically the balance sheet side of things. So that means that we had, of course, if we pull out the trusty calculator, we could probably do this in our head, but so addicted to the trusty calculator in an Excel, I just can't do it. So we're going to say the land is going to be the 8,000 that is overstated now, right? Because if there was an intercompany transfer from one to the other, the company that purchased it, in this case P, would put it on the books for what they purchased it for, 32,000, and that shouldn't have happened. The whole thing shouldn't have happened, so we got to bring it back down to what it should have been, which is 24,000, which means we got to bring the 32,000 down by 8,000 to get to that 24,000. And so then we don't have to worry about the gain here again because this is a prior year transaction. It's not affecting the current year net income. So we're just going to take that 8,000 and break it out between the balance sheet accounts for the controlling and non-controlling interest, those being the investment in S stock and the non-controlling interest in NA. So we're going to take that 8,000 times 0.7. There's the 5,600, and we'll take that 8,000 times 0.3. There's that 2,400. Then if we were to post this out, we got the land up top. We got the credit to it, bringing the land on down. And then, and there's more than just that 24,000 in land, clearly. So that's why it's not equal in the 20. In any case, we then got the investment in the stock up top. So investment in the stock. So there we have it. And that brings us back down to 0. It's included here, and that brings us down to 0. So that's an exciting moment. So we're going to stop for a second, celebrate, a little silence. Okay. And then we got the non-controlling interest in NA. Non-controlling interest in NA is going to be included here. So there we have that. So now we're going to go on down and look at some transactions related to the bonds, which is what we've been waiting for. So if it's about time we get to the bonds down here. So we got the transactions we've done thus far are up top. Those are included in the consolidation row here, as well as the current transaction we're working on related to the bonds. Now here's the bond information. January 1st, 2000 X1, S sold bonds to P, so S issued the bonds directly to P, and they were issued for the 50,000, the rate 8%, and the years 10. Now let's break this out into the two components, meaning the balance sheet component and the income statement component. Because they were issued directly from one to the other, they should mirror each other well, and therefore we can kind of break them out between the balance sheet and income statement side of things. In practice, we can actually basically see them on the balance sheet, right? We can see now there might be other bonds than just this one, but we should be able to break down in a subledger the bonds that are intercompany bonds and be able to simply reverse them, right? So in other words, if I was to take a look at the bonds over here, I'm going to say, oh, the bonds payable are going to be the 50,000 for the bonds payable, and those are going to have to be removed. So I'm just going to say that's a credit, so I'm going to remove the entire thing with a debit to take them off the books. Any related discount related to those bonds that are all intercompany then needs to remove as well. The discount's on the books as a debit because it's a discount. Therefore, to remove it, we're going to do the opposite thing to it, which would be a credit. Now, it could be a little bit more tricky if a book problem, didn't give you the amount of the discount right here. We might take a look at that in the future. You'd basically have to calculate what the discount was at a certain point in time and then remove it. But the point of this problem here is, of course, we got to remove the entire discount at that point of the consolidation. Then we have the investment in S bonds that's got to be removed. So if we look at the other side of things, again, the investment in S bonds is going to be the $46,500. It's on the books. We can see it right there. We got to remove the entire thing. So we got to remove the entire thing. So just note, in a book problem, they could get a little bit more tricky here, which isn't really an advanced financial accounting kind of issue. It's more of just calculating the bond issue, which is to ask you, well, what was the premium at this point in time? They can give you enough information for you to figure out what the discount or premium, if it was a premium, was at that point in time. And then you'd have to calculate that out and then, remove it at that point. In practice, of course, you'd probably be able to see the discount or premium might be included with other discounts or premiums, but you would then have the subledger that you can kind of break that out. So there is that. And so we got the balance sheet side of things. Now let's take a look at the income statement side of things. So if we were then, all these transactions have thus been recorded so far. They've been included in this consolidation column. The income side of things, we would expect then income and expense, or interest income and interest expense, to be overstated. For interest income for P, because they're the ones receiving the interest income, and then we've got the interest expense for S. We would expect to have to eliminate those transactions. Now, the only question here, in practice, you may be able to find that too, because although it won't be the only interest expense and interest income, you can probably drill down on that data and have the subledgers or run reports to see where the interest is coming from. So you can see the interest that came from the bonds that are intercompany bonds. They should be equal and opposite and reverse them. Now, in a book problem, they may ask you to calculate those items, which means you'd basically have to calculate what happened with regards to the bonds activity during the current time period, at least from a yearly perspective, to figure out what the interest income and the interest expense was. We also might have an accrual, which we do here, that we'll have to deal with as well. So in terms of the interest income, we could say here's the data we did before. We calculated the items that would be recorded on P's books and S's books, or a format that could be recorded in, and that was this. And if we were to look at the interest income, if we add them up, they came up to the 45,000 interest income and 4,500 of the expense. Once that's known, then of course we can just remove it, because obviously the interest income is overstated as well as the expense. They shouldn't be there. No real effect on the net income because they net each other out, but there's an overstatement of the interest income and expense. So let's go ahead and remove them. We're going to say interest income has a credit balance. In order to make it go down, we're going to do the opposite thing to it, which is a debit. The interest expense has a debit balance. In order to make it go down, we'll do the opposite thing, a credit. So the interest income will go here. Here's the interest income. We are removing it, bringing it back down to zero. In practice, interest income may not be including just the intercompany transactions. Most likely will not, but it's useful to be able to see it, at least in one problem where it's the only thing in interest income, so we could see the reversal of it. Then we've got the interest expense down here. Again, removing it, and like, again, that it's even more or less likely that the interest expense only includes the intercompany transactions, so probably won't bring it down to zero, but of course we're going to be removing the portion of the interest expense related to the intercompany transactions. Okay, and then one more thing we had with this, and that was, and you can kind of see this if you were to look at the statements. You're going to say, look at this interest receivable. That looks kind of, the question is, whenever you see the receivables, any receivable and payable, a question is, well, are any of those receivables coming from the other company, or a payable coming from the other company down here? And to do that in practice, we can look at the subledgers, typically look at the subledgers and see who the interest receivable is owed to us from, and look at the subledgers and see who we owe with regards to the interest payable that will be on the books. And if it happens to be the parent or subsidiary, then we have an intercompany transaction that we would have to reverse. In practice, of course, again, you might have to do those accrual journal entries just to figure out what would be in the interest payable. And we did that up top once again. So you'll see that this transaction would be like an accrual transaction at the end of the year. So you just got to check when the actual payment happened for the interest. If it happened in December, then you don't have, then they're removing the accrual issue. And in our case, they paid in January 1st, which they did on purpose. You know, we did on purpose just to add the accrual there, right? So then we got the interest receivable on the books and the interest payable that we will have to remove. So to remove them, it'll be just straightforward transactions, just like the other receivables and payables. Payable has a credit balance. We're going to do the opposite thing to it, a debit to remove it. Interest receivable has a debit balance. We'll do the opposite thing, a credit to remove it. So posting those out then, the interest receivable is here. We're going to take that down, take it down to 0 because it's all intercompany. And then here's the interest payable, removing it, bringing it on down to 0 as well. End of the day, you can do a few check numbers and just figure this number needs to be down to 0. This number needs to be down to 0 because those are the intercompany transactions. The equity section will typically reflect the parent equity section at the end of the day. And any bond-related accounts that are intercompany should then be removed. So any bond payable related to intercompany bonds should be removed, as well as any discount or premium. Any investment in the bonds also that are intercompany should also be removed at the end of the day.